In April 2016, we added NextDC to the Morgan's high conviction list. The three reasons we have done this is firstly, the February result just proves that it's a high quality business generating great returns on capital. The second point is that we think it's likely to be included in the index coming up, the ASX 200 index. And the third point is around the possibility of them cornerstoning new facilities. So if we talk about each of those points in a little bit more detail, I'll start with the return on capital. So if you look at the February result, you can now see that both Brisbane and Melbourne are generating returns on capital above 20%. Now that's a really good return on capital. It's better than what you're seeing in most of the ASX 200 companies. And it's really important because this company has invested hundreds of millions of dollars in building these data centres, and clearly shareholders would like to see that that money is being spent wisely and they're getting good returns. And now we've got some reference points that we can look at to prove that in fact that is very true. The return on capital is great, and clearly that's a real positive to give investors a lot more confidence, but it also bodes very well when you look at the barriers to entry in this business, which are very large. So we're very comfortable with the return on capital they're generating from the core businesses. The second point of interest is ASX 200 index inclusion. Now this is really important because this is a company that's really only been around for 6 years, and now it looks to us like it's on track to end up in the ASX 200, the 200 biggest companies in Australia. There's meant to be an index rebalance announced on the 10th of June, and we're optimistic that NextDC is one of the top priorities to end up there. And should that happen, we think you'll get some ongoing buying as index funds look to add that to their portfolios because it goes into the index. And the third point, which is really the most interesting one in my view, is the potential to cornerstone the new sites. So late last year, NextDC raised debt and equity and said that they would build a second Brisbane and a second Melbourne data centre. Now, if you stop for a minute and look back, you can see internationally what happens is these big credible operators like NextDC, the competitors like Digital Realty, Equinix, and Global Switch, what they tend to do, because they're spending so much money, what they tend to do is try and cornerstone their new sites. And we think that that's definitely a possibility for NextDC this time round. They've been operating and very credibly operating for a long time now. So they've got referenceability and they certainly have the potential to cornerstone these sites. And if they cornerstone these sites, and if they get some customers that are prepared to sign up before they break ground on these sites, what it means is you could see incremental EBITDA from here as opposed to new facilities having a negative impact on EBITDA because there's costs associated with them. So this time around, NextDC is going to own the land and building, so you don't have rent. That's going to help. You don't have a lot of additional overhead costs because they've already got sales and technical engineering style people in their cost base already. And if they can get some cornerstone customers, we think it's going to be EBITDA accretive from day one, which would be a real positive and certainly give the stock a kick along. So they are the three key reasons we've added NextDC to our high conviction picks.